There we go. And Michael, do you want to say a few words about the importance of this before Graham and Lena get going? And again, a big thank you to them for putting this all together for people in our community. Michael. Michael, you're on mute.
There, how about that? Thanks, Colleen. Judy Jones and I started looking at the ERC a few weeks ago, and I'd asked my accounting firm originally to look at it, and no fault to theirs, it was kind of over their head. So Judy and I started delving into the law. We downloaded some videos. We went to the very unhelpful IRS site, which the information, I think at that time, was changing pretty rapidly, and the final guidelines didn't even come out. And Judy could, or Graham could probably attest to this, but I think it was just a couple weeks ago before the forms were available. But just in a nutshell, and Graham Ralston has been a huge help all throughout this whole pandemic, for me personally and for our community, and can't say enough about that guy. But Judy and my work, especially Judy with Graham, and really just Graham overviewing the work that we did, was enormous, and the amount of money is enormous. I can't say that enough. If you had employees in 2020, and I don't know what the sweet spot is, Graham can maybe attest to that. I had quite a few in the middle of July, just so you know, between both of my restaurants, we have about 78 normally. And I think that's where we peaked out in 2019. But we also have people coming and going throughout the whole year. So even though I got a PPP loan, mine came in April 16th of last year. I had a small window that the ERC in the first quarter was available for. It was very small, but there was still some money there. I didn't get anything for the second quarter of 2020, but I got pretty much everything there was to get, especially in the third quarter last year. For restaurants, it was very important because we were operating at 50% in the third quarter. The fourth quarter wasn't quite as lucrative because they shut us down again, but there was still some money there. So the big thing is, don't let the complexities of this freak you out. I'm guessing if you had 10 or more employees, and that's just off the top of my head, it's probably worthwhile to at least look at that. And it's even bigger in 2021. So the amount that you can get and the amount per employee, plus you can, it's per employee per quarter instead of for the whole year, even with the PPP loan. So just put the X in the box. My PP started April 16th. It was pretty much, I'd hit the threshold for repayment, for forgiveness early in July. Anything before or after that, I can include in my ERC. So what we're working really hard on right now, besides we need to bring people back to work, which has become a very difficult task. Again, here we are. My second PPP loan that was funded last month, I'm in that same boat. I need to get to that threshold of forgiveness as quickly as possible so that I get into the window of the ERC quarter by quarter again. So that's pretty much it in a nutshell. It's just a lot of money, folks. It's well worth the brain damage. So.
Okay, thanks so much, Mike. I think that's a good way to put it. It's a lot of money. It's worth the brain damage. So with that, Lena and Graham put a lot of time into creating these slides. So Lena, if you want to get going and start our presentation, I'd appreciate it. We've got about 50 minutes here. So.
Okay, thank you for the introduction. I'm just getting my screen share going here, and you should see it now. So I'm looking forward to talking. Graham and I have been working together on putting together the presentation for the Employee Retention Tax Credit. And as Michael mentioned, this can be very lucrative for some businesses. It just depends on a lot of factors. We'll start with, hold on a second, my slide is not moving. Okay, so we're going to review a few things today. What is the Employee Retention Tax Credit? And as we were just discussing, you might see it referred to in two different ways. The Employee Retention Tax Credit was basically what the language was at the beginning. Now it is called the Employee Retention Credit. We're going to talk about who's eligible to take the credit, the eligibility and limitations for 2020 versus 2021, how you can claim the credit, and some other considerations. And then we want to leave time for questions at the end. So let's get started. The Employee Retention Tax Credit is a refundable credit against certain employment taxes equal to a percentage of the qualified wages during a certain period of time. So it started in March 12th of 2020, and with the extension of the American Rescue Plan this year, it is through the end of the year of 2021. So that makes it a little bit more, there's a bigger opportunity for some businesses with those extensions. And, you know, from the outset, I'd like to say that all of the information that we've been covering, the PPP, the EIDL, the tax credits that are available to you are fluid. Things are changing on a weekly basis. And so what we know today might be different tomorrow. So just keep that in mind and make sure you work with your accounting and tax professionals so that you understand what's happening with these laws as they're constantly changing. So essentially, the wages that you're paying to keep your employees working is what dollars you can use as a tax credit. And this can be used immediately, but there are some concerns with that, but this can be used immediately against your 941 employment tax deposits, or you can get a refund of those funds in a particular manner. Who's eligible to take the credit? Employers that carry on a trade or business, including tax-exempt organizations, are eligible for the credit. And there's two criteria. One is that you've had a significant decline in gross receipts in 2020 compared to 2019, or 2021 compared to 2019. And we'll talk about that a little bit more on the next slide. The other criteria is that you've had a partial suspension of operations because of a government shutdown order. Now, this one has been a concern for me from the beginning of, and looking at this last year. What does that mean? You know, we all know that in Washington State, the governor has, that most of our businesses, all of our businesses in 2020 were subject to a government shutdown order. But how does the IRS view that? What is the criteria for quantifying that government shutdown order? And how conservative do you as a business owner want to be? Those are all considerations when trying to determine if you're eligible. There are, and we're not going to get into every single detail, but some additional eligibility requirements that you may need to consider are whether or not you have over 100 employees or not. If you do, there may be limitations to your credits. And then for tax-exempt organizations, you really have to look at whether or not you're partially suspended, assuming that you don't qualify with the gross receipts criteria. Tribal businesses are also eligible for the credit, and generally government employers are not eligible for the credit. And you'll see on this slide that I have documented on here to look at the notice, which is the IRS notice 2021-20, which is called the new 2020 ERC guidance. It can be located on the IRS website. It's about a 125-page document, but it has some great information in it, some of which I've included in the PowerPoint. So let's talk a little bit more about what is a significant decline in gross receipts and what qualifies as a full or partial suspension of operations. So for 2020, the significant decline in gross receipts means you have to have 50% of your gross receipts when compared with 2019. So, and that's for the whole year. You would look at from January through December, were your 2020 gross receipts half of what it was in 2019? If it was not, then you're not eligible using this criteria. For 2021, your gross receipts are evaluated by quarter. And so when you're looking at first quarter of 2021 compared to first quarter of 2019, were your gross receipts 80% or less when comparing to 2019. And again, I have another slide that gets into this a little bit more specifically. Now, a full or partial suspension of operation is an interesting factor to consider. And I have some examples from the IRS publication that we'll talk about. So how do you calculate your significant decline in gross receipts? And I have a chart here that shows for 2020, and these are just some examples you can put in, look at your numbers. So in 2020, if my gross receipts are $49,500 compared to my $100,000 in 2019, it's a reduction of 50.5%, so I'm eligible. If I was at, $50,500, I would not be eligible because I was not less than 50%. So you can see in my example for the 2020. The other thing that was interesting, and there's additional guidance on this related in the publication that I referred to, is how do you define gross receipts? And I'm not sure if Graham has input on this, but gross receipts would include your revenue from the services that you're providing or the product that you're selling. It would also include your interest income or any other income that you're showing. It defines in the publication what qualifies as gross receipts. What I am not sure about, and Graham, pipe in if you have some input on this, is whether or not the grant funding that was received, or a lot of businesses have received grant funding, they've received the PPP funding. I don't believe that that's included in gross receipts, but it's hard for me to determine that. Do you have any input, Grant?
Yeah, the guidance I've seen thus far does not include at least the other federal grants in gross receipts. It might include like a local organization or a nonprofit grant, though, in your gross receipts.
So the Lifeboat 1, 2, and 3, do we include that or not?
That the Lifeboat is a little bit trickier because that's a state grant, which is in the middle, which I know federal grants are not included. State grants, I would actually still not include those, but that's definitely a maybe with watch the guidance. And then nonprofit, yes, definitely include nonprofit or other private entity grants received.
So if I can add just a little there, the information I've received so far about Lifeboat grants, which is a county funded program, it went, feds to county to, anyway, through EDC, was a county program, but that is taxable. And then the Working Washington also, that, again, it was federal money, but it came from the state ended up getting reimbursed from federal money for those grants. That too is taxable, but anything directly from the SBA, EIDL, PPP, et cetera, is not, is the guidance I've gotten from Commerce.
Okay, thank you for clearing up that middle area on the state.
Yeah, and so this is just one of the examples of how your interpretation of the law, you need to work with your professionals and decide how you are interpreting this. And as we mentioned, there is more guidance is coming out, and so more information will be provided, and it's going to be on an individual basis what your comfort level is as far as how to interpret these rules. For 2021, it's similar. The process is similar, but we're looking at it by quarter. So if your gross receipts in 2021 were 20,000 and compared with the 2019 of 30,000, there's a difference of 33%. So therefore you are eligible. But if you bump it up to the 26,000, then you're no longer eligible because you've exceeded 80% of your gross receipts in 2019. And let's move on to the suspension of operations. So suspension of operations or partial suspension of operations, there are a lot of examples in the publication. And I just pulled out a few of them, and this is directly from the publication. And so if a government order requires a non-essential business to suspend operations, but allows essential businesses to continue operations, is an essential business considered to have a full or partial suspension of operations due to government order? So the short answer is maybe. There's a long answer in the publication. It's really hard to determine if, the interpretation of whether or not you qualify under the partial suspension of operations. And for 2020, a lot of my client base, this would most likely be how we would want to qualify them as a partial suspension of operations. Clearly, as Michael mentioned, the restaurant industry has just, had one of the bigger impacts, along with some other specific businesses. So there's clearly, yes, you can qualify based on the partial suspension of operations. Others, it might be a little bit more challenging. So let's look at number 12. If a government order caused the suppliers to a business to suspend their operations, is the business considered to have a suspension of operations due to a government order? So basically what this means is, as a business, I can't get the supplies I need to be able to have the sales. So do I qualify even if my business wasn't shut down? And again, it's a maybe. Maybe you do, and maybe you don't. You have to look at the interpretation and what the effect has been on your business as far as the reduction in the ability to provide services and generate revenue.
Hey, Lena,
yeah.
Since last year's second quarter, there was a period where every business was essentially shut down. If you didn't have a PPP loan during that period that you were using, wouldn't that quarter qualify, at least for some portion of it?
It's really hard. That has been one of the things that I've really been struggling with is what is the interpretation? So this new publication from the IRS has some great examples. My feeling when looking at the examples is that it really depends on how your business has been affected. Did you lose revenue or did you not lose revenue? So my accounting office, technically, we were shut down by a government shutdown order. All of my employees, several of my employees, I'll say, we set up working remotely. I was affected by a government shutdown order because my business changed. But how much was my revenue affected by that? Mm-hmm. And do I qualify or not? And what I was really excited about, because initially we were going to do this presentation last week, and I believe that the publication from the IRS came out since then. And so it has some really good guidance. And what I'm going to say is you just have to look at the examples in this publication and see if it makes sense to you, because ultimately, if you take the credit and you're audited by the IRS, that's when you're going to be questioned. As Michael mentioned, some businesses, this is a huge dollar amount for them. Other businesses, not so much, potentially. But it's really interesting. Take a little bit of time to read some of the examples. And they have the questions and answers, and they also have examples of businesses in that publication. So I would say look to that to see. And look at, if you look at number 13 here, it says if a government order causes the customers of a business to stay home or otherwise causes a reduction in demand for its products or services, and the business responds to the lack of demand by suspending some of or all of its operations, is the business considered to have a suspension of operations due to a government shutdown order? The answer is no. Clearly, it says no in the guidance that we're given. So again, I'm going to say, look at the documentation, see if your individual situation qualifies and you're comfortable with saying that it qualifies, and then you can use this criteria for whether or not you've had a partial suspension of operations. And I just want to mention again, when this tax credit first came out, my biggest question was, what is a partial suspension? And Washington State, everybody had a government shutdown order, but just because the government shut down your business and maybe you had to change things a little bit, I think what the IRS's perspective is how did that affect your business revenue? And did you make decisions as a business owner that generated less revenue for you? Or was it, it's a tricky one. It's a tricky one. And I'm guessing that there will probably be lawsuits as a result of this. If people take the credit and they get audited, and so it'll be interesting to see how it all shakes out at the end. But some people are more comfortable with taking the credit, and their interpretation is a little bit more liberal versus some people may want to say, I don't want to mess with it because I'm not comfortable with putting myself in that position.
So Kenny has a question. Kenny, do you want to ask your question?
You bet. Yeah, thank you. Let me unmute you real quick. I had a question related to, it seems like they're using 2019 as the baseline. So for finding out what quarters you qualify for, does it directly have to be Q1 19 to match quarter 2021 and Q1 in 2021?
Yes, you're going to use each quarter to determine. So you look at Q1 for 2019 for 2021 versus 2019, first quarter of 2019. You can't mix and match. That's been pretty clear with all of the considerations. Okay, so it wouldn't be your worst quarter in 2019. Q1's going to directly relate to Q1 in 2021, and Q2 is going to directly relate to Q2 in 2020. Yeah, and the other thing that Graham and I kind of talked about yesterday when we were preparing a little bit for this is whether or not, and there's additional guidance that we're waiting for, I think, unless Graham, you found something more specific, but I believe that so first quarter 2021, you qualify, and then second quarter of 2021, you don't qualify. I don't believe you're eligible for the credit after that point. Did you find something different, Graham?
No, I don't have any confirmation in that space at this point. And unlike the PPP, there's just less guidance that's being published on the employee retention credit as quickly as it is for the PPP. So, and as Lena stated, this is very fluid. There'll be more guidance coming out. So just stay on top of everything that is being published by the IRS. And maybe if new updates come out, we can make sure that we put some of that information underneath the recorded video link on the website, Colleen.
Can I get a quick question in here? So the way I understand this works, and you may have already mentioned it, Lena, and it went over my head, is this is kind of an either or thing, right? So you can either qualify under the 50% revenue threshold, or you can qualify under the shutdown threshold. Is that correct?
Yeah. So if you qualify with the 50% or the 80%, you're in. You're good. You're definitely eligible for the credit.
But what if I hear what you and Graham just said correctly? Say in 2021, I qualify in the first quarter, I don't qualify in the second quarter, I did in the third and fourth, or in some combination thereof, I'm still out because the second quarter I didn't qualify. So I'm done for the year.
That is what I believe my interpretation is at this point, but additional guidance will be coming out. And with the new regulation that just passed, the American Rescue Plan, and because that extended it to December, I'm confident that there'll be more guidance more quickly. So essentially, when this credit first began last year, there was absolutely no guidance available. I mean, what you got on the IRS, as you mentioned, Michael, there was very little information. So the new document that was just released has a lot of details, but not everything yet. So I would expect that there's going to be a lot more coming out. And also the AICPA has been communicating with the IRS on some of these things and asking specific questions. And so I would imagine that there's going to be a lot more guidance coming out soon.
And Michael, I also want to bring up on this point that you still have an either or for this calendar year. And at the start of the ERC for 2021, we only thought it was going to be 2 quarters. So it was just a week ago that they extended it to all 4 quarters. And that's why I'm still feeling like there's going to be more guidance as to, okay, maybe what was said previously about not working for future quarters. Well, there was only 2 to consider at the time. And now we're talking about 4 quarters for 2021.
And as you'll see, as we go along, there's a lot of unknowns at this point still. Okay, so for 2020, the eligibility requirements, and this shows an example. So eligible for 2020 tax credit, eligible wages are those paid from March 12th, 2020 through December 31st, 2020, up to $10,000 per employee, which would include your health plan if you have that. If you used wages, and Michael, you kind of touched on this at the outset, if you used wages, if wages were paid using a PPP loan, those wages are not eligible for the credit. So I believe in your example, through June or so, that was your PPP fund. So the wages that were paid between July and December, then those wages would be qualifying wages for the credit up to $10,000 per employee. The credit is equal to 50% of the eligible wages with the maximum credit per employee of $5,000. If you paid the employee less than $10,000, because particularly in the restaurant business, there's a lot of turnover. So you may have, you may have had more employees, but they didn't quite make $10,000 per year. The gross receipts were required to be less than 50% when compared with 2020, or a full or partial suspension of operations, which we just discussed. And then our understanding at this point, which again, we're waiting for additional guidance, is that officers of the business or owners of the business that have a greater than 50% ownership, their wages are not eligible, and the family members of those owners. So for example, if you are an S corporation and you have your children working for you and you have 3 employees and you're 100% owner, none of those 3 employees would be eligible. And so unless we receive different guidance out of the American Rescue Plan, that's our interpretation at this point, is that officers and owners and their family members are not eligible for this credit. Those wages are not eligible for this credit. So what's the potential credit that you can receive? And I have an example here showing an employee that made $15 an hour. Their wages per quarter would be $7,200. 50% of that is $3,600. And so the maximum credit per employee is $5,000. If you have 3 employees, not including your officers, your potential credit is $15,000 for the year. And if you had 10 employees, it would be a $50,000 credit for the year. So kind of gives you an idea of what this credit might look like. Judy, I see you have a question.
Yes, I'm concerned about, now your list has hourly rate. I'm concerned about the tips as gross, because we have tips in the gross and then we take it out as paid out. So
I would say that your tips would qualify.
Okay.
I
would say that your is that your, do you concur, Graham?
Yes, and the reason why I concur is because tips are considered a payroll expense underneath the PPP. So we already see another version where the government is considering that as a payroll expense.
Wonderful, thank you.
Mm-hmm.
Yep.
And for a lot of businesses, it may not, you know, their wages may exceed that anyway, if you were to consider the tips or not, and other things as well. And again, it goes back to how creative you want to be in your interpretation of the regulation. Graham will talk about a few things in a few minutes here. Okay, so 2021, the differences in 2021 are that your eligible wages are the same up to $10,000 per employee between January and December, but it's per quarter. So instead of looking at the whole year and having your wages limited to $10,000 for the whole year, you get that per quarter. And the PPP is still, wages paid with the PPP are still not eligible, but the credit is equal to 70% of eligible wages. So you can see that in 2021, this credit opportunity is even greater. And more businesses may be eligible due to the 80% gross receipts as opposed to the 50% gross receipts. And as you see on the slide here, my understanding at this point, which is still questionable due to the new regulations, is whether or not once your gross receipts exceed that 80% in a quarter, that you're no longer eligible for this credit. So we'll be waiting for additional guidance on that. And we have a couple months before we have to worry about it, I would say. And then you can see how the credit is different. So this is the potential credit for a $15 an hour employee versus a $28 an hour employee, and your potential credit opportunity on a quarterly basis. So let's move on to the next slide. How do you claim the credit? So, and this is kind of challenging because the one way to claim the credit is to reduce your EFTPS payroll tax deposits by the amount of the credit. So if you know you're going to be eligible for the credit as you're paying your employees, what the IRS really wants you to do is reduce those EFTPS tax payments so that you get to keep the money now. And the idea is that this will help businesses maintain their employees and keep them on the payroll. The whole idea behind this credit is to keep your employees on the payroll and have them receive payroll, whether or not they're working for you is another consideration. So for businesses that have under 100 employees, it doesn't matter if they're actually working or if they're not working, but the idea is that businesses will keep their employees on the payroll. And so one way to help businesses to pay them is to reduce the 941 payments. One thing to keep in mind is that a lot of payroll systems, I use QuickBooks almost exclusively for my clients, but your payroll system may not be set up to report properly this credit to the 941. But essentially, when you're claiming the credit, you can reduce your EFTPS tax payments. The information is reported on your 941, so make sure that you're working with your tax preparer or bookkeeper to report that information. And for most people, knowing the dollar amounts that we just were talking about, your 941 payments are going to be less than the credit that you're eligible for. And so you can claim the refund using the Form 7200. It's a pretty simple form. You complete the form here. You can find it on the IRS website. Fax the form in, and then the IRS will refund you by depositing money into your bank account directly from this Form 7200. Now, I had an interesting situation where I filed a Form 7200. The deadline for submission of the form is the last day of the quarterly reporting tax month. So look at your instructions, make sure you understand what's happening, and and then you will receive a refund for these credits. The refund is going to be interesting. Graham's going to talk about that a little bit more in a few minutes. But those are the two options on how to claim the credit, is to reduce your EFTPS tax payments, or to claim a refund by using the Form 7200. Now, the problem with taking the tax credit against your EFTPS payments is you're not going to know if you're eligible until after the end of the quarter. So potentially, right? You have to know, is my first quarter 2020 going to be less than 80% of my first quarter 2019? And you're not going to know that until the end of your quarter. So the timing of reducing your EFTPS payments is going to be a bit questionable, because you don't want to reduce the your EFTPS tax payments if you're ultimately not going to be eligible for the credit. Okay. Other considerations, and some of these are mine and some of these are Graham's, I think. So potentially you can look back at your 2020 return and 2020 information, determine if you're eligible for the tax credit. And if you are, then you can amend your fourth quarter 2020 941 form. All of the payroll that was received in 2020 can be reported on the fourth quarter 941. So you don't have to amend the other, all of your 941 forms. You can just claim the credit on the fourth quarter form 941. I just have in here, look specifically at your business and to determine if you qualify for the full or partial suspension of operations. This is going to be a huge factor for many businesses. And then if you didn't file the Form 7200 by the deadline to claim the credit, then what this is going to look like is on your Form 941, you have the option with the Form 941 to claim a refund. So on the tax credit will be included on your Form 941. At the bottom of your form, it tells you whether or not you owe additional funds or whether or not you have a credit coming back. And you have the option to apply that credit to the next quarter's 941 forms, or you have an option to receive a refund from the IRS.
How does Form 941X fall into?
The 941X is the amended 941 form. So you would fill out, you would complete the 941X form. The question becomes, do you want to apply that refund to the next 941, the next quarter's 941, or do you want to receive money, a check back from the IRS or a refund back from the IRS? And from my experience, I think it's going to be safer for you to request a refund from the IRS rather than apply that credit to the following 941. If you apply it to the next quarter, you don't want to get yourself into a situation where you're owing 941 taxes because the IRS hasn't processed your first quarter 941, and so therefore they don't have your payments posted to your second quarter 941. And this might be getting a little bit too specific, but what I would choose to do is request a refund from the IRS rather than apply that credit to another quarter, because it's just the IRS is not processing paperwork very quickly at this moment. It's been a disaster with, your 941 payments if it's not posted correctly. My guidance would be submit your amended 941, request a refund, and wait for the payment to come in.
Quick question, Lena.
Yep.
On that, are you recommend doing that on a quarter by quarter basis? So in other words, not wait till the end of the year to find out what quarters you qualified for, but once you make it through that quarter and you go, oh, I qualify, and you should look at amending that 941 for that quarter.
So preferably you would do it right the first time. For 2020, the guidance wasn't there. If you're going to go back and look to take the credit for 2020, you're going to deal with an amended 941. But going forward, you'll know before the 941 is prepared. So for first quarter is wrapping up right now. You'll have a good idea potentially of where your revenue is for the first quarter of 2020. And you can compare that to your first quarter of 2019. And then on the 941 that's getting prepared for first quarter 2021, you'll know before you do the 941. So we won't have an amended return that's going to be required.
Gotcha. So like for us, our payroll structure, how it works is we do weekly payroll. We make weekly 941 payments with that. And so to be able to claim that throughout the quarter, it's going to be pretty tricky for us. So for me, I'm going to have to wait till the end of the quarter. See if we qualify, and then amend, or actually prepare that 941 for that quarter, correct?
Yes, and so what I'm suggesting is that it might make the most sense to cause you least grief in the future if you prepare the 941 showing the refund for the credit, and then wait for the IRS to pay you for it, which is going to take a lot of time. Yeah, it's going to take a lot of time to get that processed. One trick that somebody told me recently is, if you're in this situation and you have a 941 with a big credit coming, if you mail that 941 using FedEx or UPS, the IRS receives those packages in a different process than if you just send it via US Postal Service with like return receipt requested or certified mail. And so potentially that 941 will be processed a little bit faster. And therefore a credit. I'm kind of curious to see how the IRS sends out these checks for, you know, $30,000, $40,000 or $50,000. That's a lot of money. And usually the IRS would prefer for you to reduce your 941 EFTPS payments. But I don't want to get down to the end of the quarter and say, oh, I'm not eligible. Now I got to pay $50,000 and have all of these penalties and interest. So, it'll be interesting to see how all of this shakes out. And at this point, that's the information that we have. Now, Graham, go ahead.
I see Judy has a question, or you've got your hand up. Oh, no.
I already asked you. Thank you.
Okay.
Okay, Graham, well, you were going to talk about the next couple items.
Yes. Yep. So in the next couple of slides, we're going to talk about proactive planning and billing practices and also of invoicing and a couple other strategies to make sure that you're maximizing your ERC and how that overlaps with the PPP. So let's go ahead and go to the next slide, please. So first, other considerations of the PPP and the ERC. Lena asked a couple slides ago, or brought up the point, how do you know if you're going to hit a certain threshold? Right, of the 80%, or are you going to drop by 20%? And also earlier in Lena's presentation, we talked about how do you define gross receipts? And what I want all of you business owners to be focused on is being intentional about your tax planning and accounting matters. Even more importantly, this year, it's important in general, but it's even more important to set out a plan for the rest of this year, quarter by quarter, so that you can be intentional about if that's keeping receipts low or the gross receipts low, so that you can intentionally make sure that you're falling below a certain threshold. Well, what tools do you have available for that? It matters what kind of taxpayer you are. There's a difference between an accrual-based taxpayer, which you start to record transactions as they occur, or cash basis taxpayer, which you record then on that in that quarter when cash is received or paid. This is applicable both to the PPP and the ERC. We do have the extension of the PPP, so it's important whether or not, you know, if you looked at the PPP and you told yourself, you know, I didn't have a 25% reduction in a quarterly comparison from 2020 to 2019. Well, do you have a quarterly reduction if you switched your accounting practice? If you didn't file your taxes for 2020 yet, what happens if you switch that accounting year to be a cash basis rather than accrual? Do you now have a 25% reduction? Is the brain damage that might cause you, as taking that from Michael, is that going to be worth it for you to go through the process and switching your accounting method? And for some people, if that's going to make you eligible for the PPP by switching an accounting method, and now all of a sudden you're leveraging $50, $100, $200,000, well, that's probably worth the brain damage that you're going through. That's on the PPP. Now, what about the ERC? This is where I don't want you waiting until the end of Q2 of 2021 to then look back and say, did I qualify or did I not? I want you to think about Q2 right now and say, how can I make sure, or how can I operate my business in a way that I keep my accounting method, if that's accrual or cash, at gross receipts below certain thresholds so that I can qualify for the ERC. And maybe that hurts your liquidity a little bit. Maybe you're not invoicing that extra $10,000 or $20,000, but all of a sudden, if you're taking that hit on the 10 or 20, and now you're able to leverage the ERC and you generate $100,000, well, that's going to be worth it for you. And we can talk about a tool that can help you in that liquidity gap in one of my next slides, but I'm just going to hit it again. Be intentional about your planning for each quarter throughout this year. Spend the time, get the brain damage, put in the effort now, because there's more that you can do now with planning than waiting until the end of the quarter and trying to be retroactive to see if you fit. You need to be proactive in that planning right now. I'm going to go back, Lena. I was just focused, if you go back on one slide, thanks. I was just focused on the accrual and cash. I do want to talk about overlap of the same funding. And this is just because it's a common question from clients and business owners that think, well, my PPP is in Q1 and Q2, and that means that I can't use the ERC for those quarters. That is incorrect. You just can't use the ERC for the same funds that are being reimbursed for the PPP. We'll go into that a little bit more on the next slide, but I do want to hit a couple other points below on here, which we did talk about being proactive for 21. There's more flexibility in saying which quarters and which funds are allocated to the PPP and the ERC retroactively for 2020 if you haven't already filed for forgiveness. If you have already filed for forgiveness, you're going to be tied to the application of forgiveness of stating how much money was used for payroll. So now we're going to go through some examples on the next slide. And I know the next slide is focused on 21. Lena, if you could hit that next slide for me. Thank you. But if this was a 2020 example and you had your PPP loans in Q2 and Q3, the easiest thing to do, as long as you're still eligible for the ERC in Q4, is start with the quarter that didn't have any PPP funds. Make it easy on yourself. Don't give yourself brain damage unless you need to. And then if you still have more credits that could be applied for Q3 or Q2, well, maybe not all of your employees were on in Q4. Maybe you had an employee that was there in Q2 or Q3, and maybe your PPP reimbursement was large enough, even if you already submitted your forgiveness application, where you can still make the claim for that 5,000 max credit per employee from Q2 or Q3 of last year. Okay. Do I hear a question? Oh, that might be someone that's just off their mic. So examples though of ERC for this year and how that works with the PPP. And this is also assuming that you're eligible for the ERC in each quarter. It's, you know, you've received your PPP loan proceeds in Q2, Q3. It's clear that in Q4, all funds are eligible, okay? Because there's no overlap that you need to worry about. But underneath example 2, I want to show you that you can still have a PPP loan and a ERC credit in the same period. So what can you do? What are some tools that you can utilize so that you fall underneath both? Well, first, know that the PPP for round 2 has a 60% threshold for payroll. You need to make sure in terms of payroll forgiveness. So if you have a $100,000 loan, you need to be spending at least $60,000 on payroll so that you can receive 100% forgiveness on that loan application. Okay, that means that if you're trying to utilize the ERC and the PPP, it might be important for you, as long as it's already a planned part of your business and necessary for your business, that you're trying to utilize those 40% funds of the PPP more on rent, utilities, improvements for safety, and then you're lowering the threshold of the amount of the PPP, but still at least hitting that 60%. Well, what can you do? You can use the PPP funds in excess of employees that earn $10,000 or more. So if you've got an employee in a quarter, so if you've got an employee that's going to earn $20,000 in a quarter, you apply 10,000 of it to the PPP and the other 10,000 of it to the ERC. If you have some employees that are only earning $5,000 in that quarter, and you've got a large group of them, well, maybe 50 of, and you've got 100 employees that are earning less amount, 50 of them maybe are going to be applied towards the PPP and 50 of them are going to be applied towards the ERC. It's just about careful accounting lines to track how you're spending this money. You also want to be thinking about maximum allowable compensation for owners. Lena discussed in an earlier slide that at least right now, we don't believe officers or family members may be eligible, especially for last year. We need to continue to watch guidance, but owner compensation is also capped, and you should be thinking about using PPP for owner compensation at this time. That then would free up ERC for your other employees. Let's go ahead and move. Yeah.
Okay. Just one other point on the PPP is with the new regulation that passed, and I know we're getting short on time here too, but with the new regulation that passed, it loosened up the rules on how the PPP funds can be used. So cost of goods sold items are also included in that. So for some businesses, that might be a good opportunity to use some of those PPP funds rather than for payroll, but for other costs, making sure that you keep the 60% of payroll in your PPP calculation.
Yep. Great point. I'm not going to go, since we are running short on time and this slide's going to be available. I do want to, when I talked about a solution to that funding gap or liquidity gap, that if you decide to take a hit on your gross receipts, meaning you're going to defer when you're billing people or to have that money coming in, think proactively about a line of credit so that you have the liquidity. We also don't know the timing on all the tax credit refunds, that we don't know when they're actually going to come through with any kind of certainty. So having that liquidity there to keep your operations going as a business could be important for you. But I also want to make sure that you're not just getting a line of credit to pay people that aren't generating more revenue for your business. It needs to make sense first that you would already be employing people and having that revenue come in. And this is also if you don't have enough money from the PPP and you still need additional funds, you should maybe be looking at a line of credit. Let's go to the next slide. There's also 2 new additions in the expansion in the American Recovery Act, which there's a recovery startup business that if your business started after February 2020 and had less than $1 million, you're not held to the same threshold or operation suspension standards, but your max credit per quarter is limited to $50,000. And then there's also a severely financially distressed exemption that allows businesses that had a loss of more than 90% of revenue compared to any quarter in 2019 that will also be able to take advantage of the ERC. And that will wrap it up for me.
Great. So is there any other questions out there?
I have a quick question that's not, well, sort of related to the ERC. Graham and Lena, And I know we don't really have a lot of guidance yet on that other grant bucket of money specifically for restaurants, part of the rescue package. They're saying some language will be out, I think, by April. But I don't know if you guys have looked at this yet, but I mean, the basic math is the difference between your gross receipts in 2020 over 2019, less any PPP funds that you had, and qualifying wages, and that there's that's your grant amount. I'm just wondering if they're going to throw in the ERC, potential ERC credits we get into that subtraction that you're putting the PPP in as well from those gross receipts. Have you guys, I don't know if that made any sense. Have you guys heard anything about that?
I don't have any confirmation on that, but and not to get into politics, but just looking at the administration and the Senate control, we know that there's more incentive and money going out to businesses, and I would expect more of that, understanding the political environment back there. So I wouldn't expect this administration to be finding ways to cut relief to small business owners. I would say more so on the liberal side, that I would lean towards them allowing both programs, Michael, meaning that the ERC and any new Recovery Act or any new dollars coming out. But I would also say that for any business considering these options, that they should still be intentional and proactive to take advantage of the ERC and not close any doors for themselves. That it's better to have the option of having looked at the ERC to take advantage of that and any other recovery dollars that you're bringing up in a new bill, rather than thinking, oh, if the ERC isn't going to be covered, I'm just going to get these, the new Recovery Act dollars. Because once you've shut that door on the ERC, it may be harder to go back and do any kind of retroactive changes for 2021 when you can be intentional right now and proactive in your planning to take advantage of everything.
And my only addition to that would be that I wouldn't be surprised well, we know that there's more grant funding coming in. We don't know what that's going to look like yet. I feel like I've heard a little bit of scuttlebutt about another round of PPPs and additional PPP options. So it's hard to know what's going to happen, as all of us have been experiencing over the last year. Things are just fluid in nature, constantly changing. The changes that have been happening have only been to the favor of the business and not the opposite direction. And I wouldn't expect that would change at this point with the current administration. So I agree that, I think we just need to keep our ears open and see if the ERC is a good opportunity for your business, and then evaluate whether or not it makes sense for you to try and either amend your 941 for 2020, do some planning for 2021, determine if you're eligible, look at the guidance for the criteria to see if to see if it makes sense to move forward with that.
Brain damage is the key word of the day, Michael. Good job on coining that.
So thank you so much, both of you. I see it's a bit after 9 o'clock, and I'm just putting in the chat some links to 3 different items as well that are different topics, but if any of those 3 things interest you, and I misspoke earlier, I said people could get up to $100 per month for the emergency broadband benefit. It's $50 per month, unless you're a tribal member, then it's $75, but you can get $100 off for connected devices. And the threshold's pretty high. It's for a married couple, $198,000 per year. So that program is rolling out, and I put the link to that in the chat box as well, along with, again, PPP loan programs, AKA grants, are extended until May 31st now. So everyone, thank you so much for joining us. And Lena and Graham obviously did a lot of work preparing this for everyone. This will be up on our website, Choose Clallam First, in the next few hours. So it'll be available there along with the slides. So thank you, everyone. And if you have questions, we've got Mike Rykoff from SBDC and Micah Jonette that are available, and myself available, and we can put you in touch with some experts. Some of them, are available on an hourly basis, but because this is so complex, that's certainly the way I'd go if I were running a small business, which I am. But anyway, so let us help you though through this process. So thank you very much, everyone. Yeah, thank you, Graham.
Organizing and leading. Thank you, Lena.
Yeah, absolutely. Thank you, Michael, Judy, Lena. It's been great.